This video is sponsored by literally nobody because I can't afford Bitcoin anymore. Now, before we dive into the digital gold rush that somehow convinced millions of people to store their life savings on a USB stick, let me start with a simple truth about Bitcoin. It's basically just a really complicated Excel spreadsheet that everyone agreed to pretend is money, and somehow that worked. The beauty of Bitcoin is that it solved a problem most people didn't know existed, which is how do I buy drugs online without my bank knowing about it? Just kidding. The actual problem was how do you create digital money that nobody controls but everyone can trust, which when you think about it is kind of insane because we barely trust our neighbors to return our lawnmower. So here's Bitcoin explained like you're 5 years old. Imagine if instead of your parents keeping track of your allowance, every single person in your neighborhood had a copy of your allowance ledger. Now, when you want to spend money, everyone checks their ledger to make sure you actually have it. And if enough people agree, the transaction goes through. That's basically blockchain technology, except instead of your neighborhood, it's thousands of computers around the world. And instead of allowance, it's people buying things they probably shouldn't be buying. The genius part is that because everyone has a copy of the ledger, no single person can cheat the system by just adding zeros to their account. You'd have to convince thousands of computers simultaneously that you deserve more money, which is harder than convincing your boss you deserve a raise. Now let's talk about what makes Bitcoin different from regular money, besides the fact that your grandmother thinks it's a scam. Regular money, or what finance brothers call fiat currency, is controlled by governments and central banks who can print more whenever they feel like it. Bitcoin said screw that. There will only ever be 21 million Bitcoin in existence. And that's it. No more, no less. It's like if Pokemon cards suddenly became currency and everyone agreed there would only ever be 21 million Charizards. Scarcity creates value, which is why Supreme can charge $300 for a brick with their logo on it. The process of creating new Bitcoin is called mining, which sounds way cooler than it actually is. You're not out there with a pickaxe finding digital gold nuggets. Instead, computers are solving incredibly complex math problems, and whoever solves it first gets rewarded with new Bitcoin. It's like a global math competition, except the prize is potentially millions of dollars, and the electricity bill could power a small country. Here's where things get interesting with the 4-year cycles. Bitcoin has this thing called the halving, which happens roughly every 4 years. During a halving, the reward miners get for solving those math problems gets cut in half. So if they were getting 6.25 Bitcoin per block before, now they only get 3.125. This is important because it means the supply of new Bitcoin entering the market gets reduced, and if demand stays the same or increases, basic economics says price goes up. It's supply and demand, except instead of lemonade, stands its digital currency that could either make you rich or leave you eating ramen for a year. Historically, these 4-year cycles have created pretty predictable patterns. About a year after each halving, Bitcoin tends to go absolutely bonkers, shooting up to new all-time highs as everyone and their mother FOMOs in. Then it crashes spectacularly. Everyone says it's dead, and the cycle repeats. It's happened in 2013, 2017, 2021, and if the pattern continues, we should have seen another peak around 2025, which brings us to the crash of 2026, and oh boy, was it a doozy. But let's game this out based on what typically causes crypto crashes. First, you'd probably see Bitcoin hit some insane price, let's say $150,000 or higher, driven by institutional FOMO and retail investors who just discovered crypto exists. Then a combination of factors would hit all at once. Maybe a major country announces stricter regulations, or a large institutional holder decides to take profits, or there's a black swan event nobody saw coming like a major exchange getting hacked or going bankrupt. Remember FTX? That kind of thing, but bigger. The crash would likely be amplified by leverage, because crypto traders love using borrowed money to make bigger bets, which works great on the way up and catastrophically on the way down. When prices start falling, leverage positions get liquidated, which means more selling, which causes more price drops, which causes more liquidations. It's a death spiral that can take Bitcoin from $150,000 to $40,000 in a matter of weeks. Add in some good old-fashioned panic selling from retail investors who bought at the top, and baby, you've got yourself a crash. Now let's talk about institutional buying and ETFs, because this is where things got really interesting in the last few years. For the longest time, Bitcoin was basically the Wild West. It was retail investors, crypto nerds, and people who thought the government was putting microchips in their breakfast cereal. But then institutions started paying attention. We're talking hedge funds, pension funds, corporations putting Bitcoin on their balance sheets. Michael Saylor's MicroStrategy bought so much Bitcoin, they basically became a Bitcoin company that happens to sell software. Then in early 2024, the SEC finally approved spot Bitcoin ETFs, which was a massive deal. Before this, if you wanted Bitcoin exposure, you had to actually buy Bitcoin, set up a wallet, memorize your seed phrase, and pray you don't forget your password. With ETFs, traditional investors can get Bitcoin exposure through their regular brokerage account, just like buying stocks. This opened the floodgates for institutional money. The impact of institutional buying and ETFs is kind of a double-edged sword. On one hand, it legitimized Bitcoin. When BlackRock, the largest asset manager in the world, files for a Bitcoin ETF, that's not some random crypto bro. That's serious money taking it seriously. This brought in billions of dollars in new capital, which obviously pushed prices higher. It also reduced volatility somewhat, because institutional investors tend to be less emotional than retail investors panic selling at 3 a.m. But here's the thing, it also fundamentally changed what Bitcoin is. The whole point of Bitcoin was decentralization, being your own bank, sticking it to the financial system. Now the financial system owns a huge chunk of it. These institutions aren't buying Bitcoin because they believe in the revolution. They're buying it because numbers go up and their clients want exposure. When you buy a Bitcoin ETF, you don't actually own Bitcoin. You own shares in a fund that owns Bitcoin. You can't use it to buy anything. You can't transfer it. You're just speculating on the price through a traditional financial product. Some Bitcoin purists argue this defeats the entire purpose, but most people don't care because they just want to make money. So what about current and future use cases? Right now, Bitcoin's primary use case is basically digital gold. It's a store of value, a hedge against inflation, and a speculative asset. Some people use it for international transfers because it's faster and cheaper than traditional wire transfers, especially for large amounts. There's also the whole financial inclusion angle where people in countries with unstable currencies or limited banking access can use Bitcoin. The future use cases are where things get speculative. Some people think Bitcoin will become a global reserve currency, replacing the dollar. This seems unlikely because governments generally don't love giving up their monetary control. Others think it'll become a common payment method. But this has problems because Bitcoin is slow and expensive compared to credit cards. And also, why would you spend something that might be worth twice as much next year? There's also the Lightning Network, which is a layer 2 solution built on top of Bitcoin that makes transactions faster and cheaper. If that scales properly, Bitcoin could actually become useful for everyday transactions. But honestly, most people are just holding it hoping it goes up in value, which is fine. That's a use case too. Now, let's address the elephant in the room, volatility and risk. Bitcoin is volatile as hell. It can swing 10% in a day, 50% in a month, and 80% from peak to trough during bear markets. This makes it terrible as an actual currency because imagine if your paycheck could lose half its value before you pay rent. The volatility comes from a few factors. First, the market is still relatively small compared to traditional assets, so large trades can move the price significantly. Second, it trades 24/7 with no circuit breakers, so there's nothing to stop a cascade of selling. Third, it's driven heavily by sentiment and speculation rather than fundamentals. There's no earnings reports, no dividends, no cash flows to analyze. It's worth whatever people think it's worth, and people's opinions change fast. This volatility is why Bitcoin is risky to own and especially risky to trade. If you're holding long-term, you need the stomach to watch your investment drop 70% and not panic sell. Most people don't have that stomach. They buy high when everyone's excited, then sell low when everyone's panicking, which is literally the opposite of what you should do. Trading Bitcoin is even riskier because you're trying to time the market, and timing the market is incredibly difficult even for professionals. Add in leverage, which many crypto exchanges offer up to 100x, and you can lose more money than you invested. The crypto markets are also less regulated than traditional markets, which means more manipulation, more scams, and fewer protections if something goes wrong. Exchanges can get hacked, go bankrupt, or just decide to lock your funds. There's no FDIC insurance here. If your exchange goes under, your Bitcoin might just be gone. Not your keys, not your coins, is the saying, which means if you don't control the private keys to your Bitcoin, you don't actually own it. But holding your own keys means you're responsible for security, and if you lose your keys or get hacked, there's no customer service to call. The reality is Bitcoin is a high-risk, high-reward asset that's probably not appropriate for most people's entire portfolio. Financial advisors typically suggest, if you're going to invest in crypto at all, it should be a small percentage of your portfolio that you're willing to lose completely. Maybe 1% to 5%, depending on your risk tolerance. The people who became Bitcoin millionaires either got in extremely early, got extremely lucky with timing, or had the conviction and financial stability to hold through multiple 80% drawdowns. For every person who made life-changing money, there are countless others who lost everything trying to trade their way to riches or got caught in the crash. Bitcoin might go to $1 million per coin one day, or it might slowly fade into irrelevance. Nobody actually knows, despite what anyone on Twitter tells you. What we do know is it's been around for 15 years, survived multiple crashes, and keeps coming back. Whether that's because it's actually valuable or because enough people believe it's valuable doesn't really matter. The effect is the same. Just remember, investing in Bitcoin because you think you'll get rich quick is gambling, not investing. Do your research, understand the risks, and never invest more than you can afford to lose. And whatever you do, don't take financial advice from YouTube videos, including this one.